My name is Ross Mayfield. I'm an investment strategy analyst at Baird, and we're back with another market strategy weekly video with our friends at Strategas. Today, I'm thrilled to be joined by Todd Sohn, a technical strategist. I'm going to hit him with a grab bag of questions. So, Todd, thanks for being here, and then let's jump right in.
Hey, Ross, great to be back.
Yeah, so where I wanted to start, you all do a ton of great work on ETF inflows and outflows, kind of taking the temperature of where sentiment and money is going in the market. You had a really interesting note that in 2021, equity inflows are pretty much higher than almost every other year in total in recent history. What do you all do with that data? How do you interpret that?
Yeah, the flows backdrop has been quite an interesting one. So to give it some context, from the March 2020 lows, really up until November of last year, they were quite tepid given market performance, which was fantastic. And then once you got two big events out of the way, one being the election uncertainty and the efficiency of the vaccines that are available now, flows just surged. I think it was everyone in the pool. And since that first week of November, you've seen a tremendous amount of money going into equity funds. As you mentioned, we're on pace through only the first few months of the year here to break the annual record already for equity ETF inflows. And so I think when we take stock of the sentiment backdrop, there's a lot of excessive optimism via those flows. And so while it's not a harbinger for future negative performance, we just want to be mindful of that. Positioning looks pretty full here in terms of equity ETF inflows. I think that's something to be mindful of as the slower, choppier summer months come into play here.
Yeah, and something we talked about last time was that year two off of a bear market low tends to see some more chop and volatility anyway. One other indicator that you all have been talking about for more than a year now is consumer discretionary versus consumer staples. So really risk on reopening versus risk off defensive. And that has led us pretty much straight up through the recovery, but has paused a little bit. Does that kind of fit into that same framework of could be a challenging or at least sideways few months?
Exactly. We're in year two, coming off of a market low, and that's when things typically get a little more choppy. And you're starting to see discretionary versus staples was our number one market risk and economic barometer, right? Discretionary cyclical type of stocks outperforming the traditional defensive staples. A modest pause here, not a trend change, not a big top of any sorts, but just something that says take your foot off the gas here, perhaps lighten up some exposure, particularly as this second year really progresses. We're about to hit the teeth of a weaker seasonal period in the summer. And so I just think we want to be mindful of that. There's some sort of pullback, I think, in view here. You've seen a similar scenario from high beta versus low beta stocks. That's also paused. And so just consistent with the flows we've seen, which have been very aggressive, and now risk barometer starting to pause, it just says to us, the cycle is progressing and slow things down and just expect different returns, more challenging environment now than we've seen over the last 14 months.
That makes a ton of sense. Thanks for providing that color. So with consumer discretionary pausing, I know you all do sector rankings. What sectors still look quite attractive to you all from the technical side of things?
Yeah, so our top rankings right now are financials and energy, right? Very cyclical, and the flows into those areas are very aggressive. But we think that they are going a structural change in leadership. Financials are finally breaking out over the highs they made way back in 2006 and 2007. That's huge for us, and they're a little overbought in the near term. But that's an area that we want to use any sort of weakness to start adding exposure. Similarly for energy, it's been terrible since 5-6 years ago. We think that sector's made a turn for the better. There's a whiff of inflation going on here. Commodities are acting much better. And so those are tailwinds for energy. And we wonder if rates can resume higher. They've paused over the last few weeks. Plus this inflationary backdrop that's perhaps setting up, are financials becoming the new defensive areas? I think that's something to consider rather than your traditional staples or utilities, which have not really worked at all. And so they rank well in our technicals, again, overbought in the near term, but structural changes going on here. And the economic backdrop is actually a little bit more supportive here. And so we think that you focus on those sectors, even as things get a little choppy here over the summer.
Sure. That's a fascinating way to look at financials because, post great financial crisis suggesting that would be defensive, that would be a tough sell. But now it's a totally different environment. I want to close on one last item, kind of jumping around here a bit. The US dollar, I've heard you all mention it, and different folks at Strategas say it's one of your most important calls, that the dollar continues its weakness. Do you think that continues, and what are the implications for that across the board?
Absolutely. We do think it goes lower. The 90 and 89 area and the US dollar index is a big level, big support level. If that breaks, you likely have a cascade lower. And the implications are far reaching. If you look at some of the names that are most correlated to a weaker dollar, right? Negative correlation to dollar, it's materials, it's industrials, your Caterpillars and your mining stocks. And so that supports the cyclical tone. And we also think that benefits international names. Right? European indices are very cyclical in nature. They don't have a lot of tech there as we do here in the US. And so that would support adding to an international exposure, maintaining industrials, materials, energy, and financials. And so we think if the dollar can break lower here, and it already has in a lot of individual pairs, right? That's going to be a very important macro backdrop for the next, say, 6 to 12 months, with far-ranging implications that we just talked about.
That's great insight. That's so good. Todd, I thank you so much for your time, and we'll look forward to chatting again.
Thanks, Ross. Appreciate it.